How much gold and silver do you actually need? Ladies and gentlemen, Asian guy here. If you have been watching our coverage of Black Monday, you know the score. You know the price is broken, you know the Shanghai arbitrage is screaming, and you know the banks are trapped. But right now, I need you to stop looking at the ticker tape. I need you to stop refreshing the price of silver every 5 seconds, because the price is just a number. It is a symptom of a dying system. The question you should be asking right now, the only question that matters as we barrel headfirst into 2026, is not what is the price. The question is, do I have enough? And I'm going to tell you right now, the answer is probably no. For 40 years, the mainstream financial advisors, the ones who get paid to sell you mutual funds and paper promises, have lied to you. They told you that gold and silver were just insurance. They told you to put 5% of your portfolio in metals and forget about it. They told you that metals don't pay a yield, that they are a pet rock, and that they don't beat inflation. That is a complete falsehood. It is a lie designed to keep you poor. Today, we are going to debunk that lie with cold, hard math. We are going to look at the real-world purchasing power of gold and silver. We are going to show you why the 5% rule is a suicide pact in 2026. And we are going to give you the specific number, the exact ounce count, that you need to hold to survive the transition that has just begun. We told you this year would be shaky. Mainstream analysts spent all of 2024 telling you that the US would sell its gold reserves to buy Bitcoin. They hyped the crypto narrative. They told you the S&P 500 was the only game in town. Well, let's look at the scoreboard as we close out 2025. Gold and silver are experiencing their largest gains since 1979. They are crushing the S&P 500. They are crushing Bitcoin, which is down 8% on the year while metals are vertical. And they are doing it while the entire geopolitical order scrambles to stockpile physical assets. So, let's strip away the noise. Let's look at the great reset of value. And let's figure out exactly how much metal you need to be holding when the clock strikes midnight on New Year's Eve. Many of you are looking at silver hitting $70 today and thinking, I missed it. It's too expensive. It's a bubble. You're looking at the chart upside down. We are not in a bubble. We are witnessing the bursting of a reverse bubble. You have to understand that for the last decade, silver was artificially suppressed. It was the only asset on Earth that was cheaper in 2020 than it was in 1980. While gold has been making new nominal highs in every currency on Earth since the end of 2023, silver has been lagging. It only recently beat its 2011 high when measured in Swiss francs. But here's the truth about 2026. Silver has 2 years of catching up to do. It still has to beat its inflation-adjusted highs. And I'm not talking about the fake CPI numbers the government feeds you. I'm talking about real inflation. If you adjust the 1980 high for actual inflation, silver needs to be at $81, 0 an ounce minimum. If you factor in the monetary base expansion, we are talking about $100, 00 plus. So when you see silver at $70 today, realize that it is just now getting back to fair value. The move from $50 to $70 wasn't a bubble. It was a correction to reality. The U.S. Geological Survey didn't add silver to their critical minerals list for fun. They did it because they ran the numbers. They saw the AI boom. They saw the military demand. And they realized the cupboard was bare. That news broke on November 6th when silver was still below $50. We told you then, buy. Now we are at $70, and I'm telling you now, we are going higher. But price is irrelevant if you don't understand value. Let's talk about purchasing power, because this is the single biggest argument the skeptics use against us. They say, gold doesn't generate wealth, it just sits there. Wrong. Gold and silver make life cheaper. Technological deflation is real. It gets cheaper to make things over time. Computers get faster, manufacturing gets more efficient, but you never see those price drops at the store. Why? Because the fiat currency is being debased faster than the technology is improving. But if you price the world in gold and silver, you see the truth. Let's look at the iPhone, the symbol of the modern tech economy. In 2007, the first iPhone cost $599. In 2025, the latest model costs nearly $1,200. In dollars, the price doubled. You got poor. But what if you paid in gold? Since 2007, the price of a new iPhone has decreased by 75% when priced in gold. It has decreased by 68% when priced in silver. Do you understand what that means? While the dollar saver has to work twice as many hours to buy the phone, the gold stacker can buy 4 iPhones for the same amount of metal they held in 2007. This proves that metals don't just hedge inflation, they capture productivity. They allow you to participate in human progress, while fiat currency steals that progress from you via inflation. But an iPhone is a toy. Let's talk about something that actually matters. Let's talk about the roof over your head. Everywhere you go, people are complaining about home prices. I can't afford a house. The market is broken. It's a bubble. In dollars, yes, it is a massive bubble. But in real money, housing is in a depression. We ran the numbers going back to 1990. Between 1990 and 2006, the median U.S. home cost about 457 ounces of gold. That was the standard. Today, with gold surging and real estate stagnating in real terms, so the price of a median U.S. home has collapsed to just 95 ounces of gold. That is a 53% decline in the real cost of housing since 2007. We are making new lows right now. 95 ounces is even cheaper than housing was in 1980. In silver, it tells the same story. The median home priced in silver is now approaching 6,400 ounces. That is the exact local low we saw in 2011. So if you are sitting there with dollars in a savings account, trying to save for a down payment, you're running up a down escalator. The house is getting more expensive every day. But if you are saving in gold and silver, the house is getting cheaper every day. This is why the allocation question is so critical for 2026. You aren't just buying metal to look at it. You're buying it so that one day you can trade a small stack of yellow coins for a 4-bedroom house free and clear. That transfer of wealth is happening right now. The dollar price of the house is going up. The gold price of the house is going down. And the gap between those two lines is where the rich are made. So how much do you need? If you talk to a traditional financial planner, they will tell you, put 5% in gold for insurance. I am here to tell you that in 2026, 5% is zero. Think about the risk profile we're entering. We have global debt at 335% of GDP. We have the US spending more on interest payments than defense. We have a currency war with the BRICS. We have a physical shortage of silver that just locked the COMEX limit up. In this environment, a 5% allocation does nothing. If the dollar collapses by 50% and your 5% gold position doubles, you have saved 5% of your portfolio while the other 95% burned to the ground. That is not insurance. That is a consolation prize. You need functional protection. For most people watching this channel, the new minimum entering 2026 needs to be 10% to 15% of your total net worth. That is the floor. If you have debt, if you rely on a fixed income, if you are worried about your job stability in an AI world, that number needs to be closer to 25%. Why? Because you need enough upside in the metals to offset the destruction of your paper assets. When your bonds crash, the gold needs to rally enough to cover the loss. When your cash buys half as many groceries, the silver needs to double to pay the bill. You cannot achieve that mathematical balance with a token 5% position. And form matters. We aren't talking about ETFs. We aren't talking about mining stocks. Although they have their place for speculation, we are talking about physical insurance. The 10-15% core position must be metal you can touch. Metal that has no counterparty risk. Metal that doesn't care if the COMEX is open or closed. Back in 2021, when we started talking about this, we gave you a target. We said every single person needs a baseline survival stack. We called it the 5 and 200 rule. 5 ounces of gold, 200 ounces of silver. Back then, in 2021, that stack cost about $1,300. We calculated that it would cover roughly 3 months of expenses for the average American household if the system stopped working. Fast forward to today, December 2025. That same stack, 5 ounces of gold and 200 ounces of silver, is now worth almost $34,000. Spot price for gold is up 138%. Spot price for silver is up 136%. If you listened to us then, your 3 months of coverage has turned into 6 months of coverage. Your purchasing power didn't just survive, it doubled. While everyone else is crying about inflation, you're sitting on 6 months of financial runway. But here is the critical part. Even though the price is higher today, the rule remains. You still need that baseline. If you are starting from zero today, your first goal, before you buy a stock, before you buy crypto, before you pay off the mortgage early, is to get to 5 ounces of gold and 200 ounces of silver. Why 200 ounces of silver? Because silver is the transaction metal. If we enter a period of hyperstagflation, you aren't going to shave filings off a gold coin to buy groceries. You are going to use silver. 200 ounces gives you transactability. Why 5 ounces of gold? Because gold is concentrated wealth. It is your savings account. It is the down payment on the house when the dust settles. Is it harder to get to that number today than it was in 2021? Yes, it costs $34,000 instead of $14,000. But the cost of not having it is infinite. This is the long-term trend. The earlier you position yourself, the more you benefit. But if you're sitting there thinking, it's too late, I'll just wait for a pullback, you are fighting the tide of history. The central banks aren't waiting for a pullback. They are buying at the highs. China isn't waiting for a pullback. They banned exports. You need to establish your position now. We have covered the survival stack, the 5 and 200 rule. If you don't have that yet, turn off this video, go to a dealer, and get it. That is your life raft. But for those of you who are already positioned, for those of you who want to play offense, not just defense, we need to talk about the multipliers. You see, amateur investors look at the price of silver and say, oh, it's $70, that's high. Professional investors look at the ratio. And right now, the ratio is flashing a signal that we haven't seen since 2011. Let's look at the gold to silver ratio, GSR. This is the most powerful tool in the precious metals universe. It tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, this number sits around 50 or 60 to 1. When the ratio is high, above 80, silver is cheap. When the ratio is low, below 40, silver is expensive. From October to December 2025, we watched this ratio drop from 80 to 70. Why does that matter? Because it coincided with silver moving from $50 to $60. But here's the math that should make you salivate. In a true bull market mania like 1980 or 2011, this ratio doesn't stop at 70, it goes to 40. Sometimes it goes to 30. Let's run the numbers for 2026. If gold hits our target of $4,400, which we will discuss in a minute, and the gold to silver ratio drops to its historical mean of 60, do the math. $4,400 divided by 60 equals $73, 33 per ounce for silver. That is the floor. That is the conservative estimate. Now let's get aggressive. Let's say the shortage breaks the market. Let's say the ratio drops to 40, where it was in 2011. $4,400 divided by 40 equals 110, $0 per ounce. This is why we say silver has more upside. Gold is the shield. It protects you. Silver is the slingshot. It catapults you. If you're allocating for 2026, you need to be overweight silver right now. The ratio is telling you that silver is still undervalued relative to gold, even at $70. The trade is simple. You buy silver now. You wait for the ratio to hit 40. Then you swap your silver for gold. You act like your own central bank. You arbitrage the ratio to increase your total ounce count without spending a single extra dollar. Now, let's talk about the specific price targets, because up is not a target. We need numbers. For silver, the chart is technically very clear. The current support is at $58. We built a massive base there in late 2025. The next major resistance, the ceiling we need to punch through, is at 74. So Ur's arrow. Why $74? Because that is the Fibonacci extension from the 2011 high. It is the algorithmic line in the sand. Once we break $74, there is no technical resistance until $100. We call this the air pocket. When an asset enters an air pocket, it moves violently. It can go from $74 to $90 in a week. Now, look at gold. Gold is currently hovering near all-time highs. But look at the 50-day moving average. It is sitting at $400 to $100. It has acted as a trampoline for this entire rally. Every time gold touches it, it bounces. If we apply the ratio target to gold, if the gold to silver ratio hits support at the 2021 lows, around 65, we are looking at a gold price target of $4,110 per ounce in 2026. This aligns perfectly with the debt cycle. The US debt is compounding. The interest payments are compounding. The gold price is simply mirroring that compounding. $4,800 isn't a moonshot. It is just the mathematical reflection of $40 trillion in US debt. I need to pause here and give you a warning, a serious one. Because I just gave you bullish targets, $110 silver, $4,800 gold, you might be tempted to go all in. You might be tempted to use leverage. Do not do it. We are entering a period of what economists call volatility clustering. In financial markets, volatility is not evenly distributed. It comes in clusters. Long periods of calm are followed by violent explosions of chaos. 2026 will be a cluster of chaos. You will see weeks where silver drops $10 in a day. You will see mornings where gold flashes down $200 because a margin call hit a hedge fund. These are not crashes. They are shakeouts. The market is designed to transfer wealth from the impatient to the patient, if you're leveraged, if you're trading on margin. You will be wiped out during these shakes. You will be forced to sell at the bottom, right before the price rockets to new highs. This is why your allocation must be physical. Physical metal has no margin call. Physical metal has no leverage. If silver drops to $50 tomorrow, you still own the same number of ounces. You don't lose anything unless you sell. The volatility is the price of admission. If you can't handle a 20% drawdown, you don't deserve the 100% gain. This is the question nobody answers. When do I sell? Do I sell at $100? Do I sell at $200? If you sell your silver for dollars, you have lost. You are trading a hard asset back into a dying currency. That is like jumping out of a lifeboat back onto the Titanic because you forgot your hat. The exit strategy is not to cash out. The exit strategy is to rotate. You rotate from overvalued assets to undervalued assets. Right now, gold and silver are undervalued. Real estate, in real terms, is becoming undervalued. Land is undervalued. Here's the game plan for 2026. Ride the wave. Hold your metals as they revalue. Let them go to $100, $150. Watch the ratios. Watch the gold to home price ratio. Watch the gold to acre of land ratio. The swap. When 500 ounces of silver can buy you a rental property free and clear, that is when you sell. When 10 ounces of gold can buy you 10 acres of productive farmland, that is when you sell. You are trading dead money, metal, for live money, income-producing assets. You never touch the dollar. You use the dollar only as the mechanism of transfer. This is how the dynasties of Europe built their wealth. They didn't hoard gold forever. They used gold to buy land when blood was in the streets. 2026 will be your opportunity to do the same. One final concept you need to master for 2026: real yields. Your broke brother-in-law will tell you, but my savings account pays 4% interest. Gold pays nothing. He is the sucker at the poker table. Yes, his account pays 4%, but inflation, real inflation, the cost of steak, insurance, and energy, is running at 8% or 10%. His real yield is negative. 4% minus 10% equals 6%. Every year he is losing 6% of his purchasing power. He is slowly bleeding to death, and he thinks he's making money because the number on the screen got bigger. Gold pays 0%. 0% minus 10% inflation equals a 10%, if the price stays flat. But gold doesn't stay flat. Gold reprices to match the inflation. So gold effectively yields inflation plus premium. In a world of negative real yields, which is guaranteed for the next decade because the US government cannot afford positive real rates, gold is the only high-yield asset. It yields purchasing power preservation. Do not get seduced by the 4% yield in the bank. It is a trap. It is the cheese in the mousetrap. Everything we have discussed so far, the ratios, the charts, the supply deficits, that is just finance. Finance is a game of numbers. What we are about to discuss in this final chapter is not a game of numbers. It is a game of power. Because you cannot understand the price of gold and silver in 2026 without understanding the war that is being fought for the soul of the global monetary system. We are not just seeing a bull market. We are seeing the de-dollarization of the world. And there's a specific reason why the price of silver is exploding right now, at the end of 2025. It isn't just because of solar panels. It isn't just because of AI. It is because the enemies of the United States dollar, the BRICS nations, the global south, the oil producers, have figured out the ultimate weapon. They realized they don't need to launch missiles to defeat the West. They just need to drain the COMEX. Let's look at the map. For 50 years, the world ran on the petrodollar. Saudi Arabia sold oil in dollars. The world needed oil, so the world needed dollars. The US printed the dollars, bought the oil for free, and exported its inflation to the rest of the planet. It was the greatest scam in economic history, and it worked beautifully, until it didn't. In 2024, that pact officially died. Saudi Arabia joined the BRICS. In 2025, we saw the consequences. We are now seeing oil trades settled in yuan, in rupees, in gold. But here's the mechanism that the mainstream media refuses to explain to you. When China buys oil from Iran, or when India buys oil from Russia, they aren't keeping those soft currencies. Russia doesn't want rupees. They can't spend them. So what do? They convert the trade surplus immediately into physical gold. This is the shadow bid that has been under the market all year. It isn't Wall Street buying. It isn't the retail investor buying. It is nation states settling their trade balances in bullion because they no longer trust the US banking system. They saw what happened to Russia in 2022. They saw the US seize $300 billion in reserves. And every central bank governor in the global south learned the same lesson on the same day. If your wealth is in dollars, it is not your wealth. It is a permission slip from the US Treasury. Gold requires no permission. Silver requires no permission. This is why the Shanghai Premium exists. China is sucking the physical metal out of the West to build a new financial firewall. They are preparing for a world where the dollar is weaponized against them. And in that world, he who holds the metal makes the rules. So when you ask, how much do I need? You have to ask yourself, do you want to hold the currency of the declining empire, the dollar? Or do you want to hold the asset of the rising powers, gold? The smart money has already chosen. There's no greater hypocrite on earth than a central banker. Listen to what they say in public. Jerome Powell says, gold is not money, it's an asset class. The ECB says, Bitcoin is risky, gold is archaic. They tell you to hold paper. They tell you that inflation is 2%. But look at what they do. In 2024 and 2025, central banks bought more gold than at any time in recorded history. Not just China, Poland. Why is Poland buying? Because they are on the border of a war zone. They know Papers Laudes won't save them. Singapore, one of the most sophisticated financial centers on earth. They are stacking gold bars. Turkey, India, Czech Republic. Why are they doing this? If gold is a pet rock, why are the most powerful financial institutions in the world hoarding it? Because they know the system is insolvent. They know the debt math doesn't work. They know a reset is coming. And when the reset happens, when they have to revalue the currencies or launch a new digital dollar, they need collateral to back it up. They aren't going to back the new dollar with faith and credit. That faith is gone. They are going to back it with gold. Imagine a scenario where the U.S. Treasury announces the new dollar is now pegged to gold at $20,000 an ounce. If you own gold, you just became rich. If you own paper dollars, you just got devalued by 90%. The central banks are front-running this trade. They are buying the insurance policy before the house catches fire, and they are hoping you don't notice. They want you chasing Nvidia. They want you chasing meme coins. Because if you started buying gold, the price would go to $10,000 tomorrow, and the game would be up. They are suppressing the price to buy time for themselves. Don't let them take your seat at the lifeboat. Now we arrive at the darkest chapter. The reason why 2026 is the deadline. Central bank digital currencies, CBDCs. This is not a conspiracy theory. It is written in the white papers of the Federal Reserve, the ECB, and the IMF. They are building a programmable digital currency to replace physical cash. Why? They will tell you it's for convenience, or safety, or fighting money laundering. Those are lies. They are building it for control. In a CBDC world, your money is not your property. It is a database entry that the government controls. They can program it. Negative interest rates. They can deduct 1% from your account every month to force you to spend. Expiration dates. They can say, this money expires in 60 days, spend it or lose it to stimulate the economy. Carbon quotas. They can stop your transaction at the gas station because you hit your carbon limit for the month. Political freezing. We saw it in Canada with the truckers. We saw it in Brazil. If you dissent, they turn off your wallet. The system is coming. The FedNow system launched in 2023 was the plumbing. The digital dollar pilot programs are running right now. When they ban cash, and they will try to ban cash, likely under the guise of fighting tax evasion or a climate emergency, what is your exit strategy? If you cannot use paper dollars, and you don't want to use the digital control token, what do you use? You use silver. Silver is the only anonymous, physical, untrackable money left. You can trade a silver coin for a generator. You can trade a silver bar for a side of beef. No QR code, no facial recognition, no government permission. This is why they hate it, and this is why you need it. Your allocation of silver in 2026 is not an investment. It is liberty. It is your ability to transact outside the matrix. If you do not hold physical metal, you're 100% dependent on the digital grid. If they turn it off, you starve. If you hold silver, you have options. This creates a freedom premium on the metal. In a CBDC world, silver doesn't trade at spot price. It trades at a massive premium because it is the only way to buy privacy. Do you think a Silver Eagle will cost $70 in a cashless society? Try $500 because you are buying the right to be a free human being. This leads to the question we get in every email. But won't the government just confiscate it like FDR did in 1933? It is a valid fear. Executive Order 6102. FDR forced Americans to turn in their gold, but 2026 is not 1933. In 1933, the dollar was backed by gold. To print more money, the government needed the physical gold. They confiscated it to recapitalize the Federal Reserve. Today, the dollar is backed by nothing. They don't need your gold to print money. They just type zeros on a computer. So they likely won't send soldiers door to door to take your coins. That is inefficient and dangerous. Instead, they will use a different weapon, taxation. They will likely implement a windfall profits tax on precious metals. They will say, gold is a speculative asset for the rich. You must pay 80% tax on the sale, or they will try to make it illegal to transact in bullion. How do you protect yourself? Privacy. Never talk about your stack. Never post photos of it. The first rule of Fight Club is you do not talk about Fight Club. Small denominations. This is why we love Silver Eagles, Maples, and junk silver, pre-1965 US coins. If you have a 100-ounce bar, that is a reportable transaction when you sell. If you have a roll of dimes, that is grocery money. It flies under the radar. In a confiscatory environment, junk silver becomes the ultimate currency of the people. No paper trails. When possible, buy locally with cash. Keep your name off the digital ledgers. They can only confiscate what they can find. and they can only tax what you declare. The goal of your 2026 allocation is to be invisible. You want to be the gray man, or the guy who looks broke on paper but sits on a fortress of purchasing power at home. We have talked about inflation. We have talked about recession, but we need to address the tail risk, the risk that has a 5% chance of happening, but a 100% chance of ruining you if you aren't ready. Hyperinflation. We think it can't happen here. We are America. We have the world reserve currency. So did Rome. So did the British Empire. So did the Dutch. Every fiat currency eventually goes to zero, every single one. The success rate is 0%. The US debt spiral is currently mathematical. It is exponential. We are adding $1 trillion in debt every 100 days. Soon, it will be every 60 days. Then, every 30 days. At some point, the bond market breaks. No one buys the debt. The Fed is forced to print everything, and the confidence evaporates overnight. If the dollar loses confidence, the price of gold goes to infinity. Not because gold is worth infinity, but because the denominator, the dollar, is worth zero. In Weimar Germany, people swept gold dust on the floor to buy a loaf of bread. In Venezuela today, people shave flakes off a gold ring to pay for lunch. In Zimbabwe, they use US dollars, until the US dollar becomes the Zimbabwe dollar. If this scenario hits, your 5% allocation is a joke. Your stock portfolio is a joke. The only thing that matters is how many ounces do you have? If you have 5 ounces of gold and 200 ounces of silver, you are the local bank. You are the warlord of your neighborhood. You have the capital to restart society. If you have 0, you are in the bread line waiting for the government to hand you a ration card. We allocate for 2026, not because we want this to happen. We allocate because the math says it is happening. The timeline is the only variable. We have covered a lot of ground today. Let's simplify it. Let's boil it down to a checklist for you to execute tomorrow morning. 1. The number. Ignore the 5% advice. Target 10% to 15% of your net worth in physical metals. If you are worried about the system, push it to 25%. 2. The stack. Your first milestone is 5 ounces of gold and 200 ounces of silver. Get there as fast as you can. Sell the jet ski, sell the extra clothes, cancel the subscriptions, get the metal. Once you hit that milestone, aim for 10 and 500, then 20 and 1,000. 3. The mix. Be overweight silver right now. The ratio favors it. Target a 2-3 silver, 1-2 with 3 gold split for new purchases until the ratio drops below 60. Then rotate into gold. 4. The form. Buy physical. Coins and bars. Avoid high premium numismatics, collector coins. You want weight? Buy some junk silver, dimes, quarters for barter. Buy some 1-ounce gold coins for wealth storage. 5. The mindset. Stop checking the price in dollars. Start measuring your wealth in ounces. I gained 2 ounces this month is a better metric than I made $500. One is real, the other is an illusion. I want to leave you with this final thought. The window to position yourself is closing. We saw what happened today with the Shanghai Gap. We saw the dealers sell out. We saw the limit up halt. This is the tremor before the earthquake. Right now, you can still find metal if you look hard enough. You can still trade your paper dollars for silver, even if the premiums are high. But a day is coming, maybe next week, maybe next month, where you will not be able to get it at any price. The dealers will be empty. The mints will be closed. The buy button will be grayed out. And on that day, you will be divided into 2 classes of people, those who have and those who have not. Do not be the person who calls me in 6 months asking, "Where can I buy silver?" I won't be able to help you. Nobody will. You have the knowledge, you have the targets, you have the warning. Now you need the courage. It takes courage to bet against the herd. It takes courage to convert your safe savings account into a heavy metal bar that pays no interest. It takes courage to be your own central bank. But look at the world around you. Look at the debt. Look at the wars. Look at the lies. Do you really feel safe in their system? Or do you feel safer holding the only asset that has survived every empire, every war, and every collapse for 5,000 years? The choice is yours, but you have to make it now. Get your house in order. Get your 5 and 200. And secure your future before they decide it for you. We at Currency Archive want to thank you for being part of this movement. Remember to like and subscribe. And if this message resonated with you, share it. Wake up your family. Wake up your friends. We are building a lifeboat, and there is still room. But the tide is rising fast. Stay safe. Stay stacked. And we will see you on the other side of the reset.